This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, let's carry on with budgeting, chapter 11. And we looked at example 1, but on the next page, you'll see types of budget. And you've got there fixed, flexed, and rolling. So let me explain what each of those are. First of all, the fixed budget I'll explain the use of it shortly, but that's the original budget prepared usually for the coming year. Oh dear, oh dear. I can't spell. That looks awful. I wish I hadn't bothered writing it. I say usually for the coming year. Usually people budget for the following year. You know, in November you may prepare budgets for the next calendar year. That's not a rule. You can budget for any period you like. But I think you know what I mean. However, one big problem with that is that however well you might be budgeting, inevitably things are going to change. You know, you may have budgeted you're paying labour $5 an hour. At the moment that seems very reasonable. But next year there may be high inflation. You may find you're forced to pay $6 an hour. And the budget immediately becomes out of date. You forecast materials that cost $10 a kilo. The supplier puts the price up. You know, your budget is wrong. And so there's a big problem that it rapidly goes out of date. But two things lead from there. One is that what a lot of companies do, it's not a rule, but what a lot of them do is perhaps every 3 months look at the budget, and if things like the price of materials has gone up, redo the budget. So you may update it. But the other thing quite important is that whatever may go wrong with it, it does remain the overall target. Now what I'm getting at, suppose I've done a budget and I forecast next year we're going to end up with a profit of 50,000. But then perhaps early in the year the price of materials goes up. And because of that, it's going to hit the profit. That will pull the profit down. Well, we're not going to just lie there and say, oh, what a shame. We were hoping for 50,000. We're only going to make 45,000 now. Surely, materials may go up, but we'll look for any way in where we can save the money elsewhere. You know, oh, we're having to spend an extra 5,000 on materials. Can we get the materials cheaper? Can we use less material? Can we cut the number of workers? Can we save 5,000 somewhere else? Surely, if we originally budgeted on 50,000 profit, that remains our target. And whatever goes wrong, we'll still be looking for ways of achieving the 50,000. And so this does remain the overall target. So we call that the fixed budget. However, moving on, I did say in the last lecture that one reason for doing budgets is so we'd have something to compare with. That as we went through the year, we could compare actual with the original budget and to see have we overspent, has something gone wrong or are we doing well? Well, for reasons I'm about to explain with the example, we'd in fact use a flexed budget. Now, I'll write down what that is in words after, but let me show you with the example what it is and why it's relevant. It's a very, very short example. Example 2. The company has prepared the following fixed budget for the coming year. We budgeted on selling 10,000 units and producing 10. And we budgeted that the materials, sorry, I beg your pardon, I'll do a profit statement. You've got those budgeted costs there, and below it says budgeted selling price is $10 a unit. So the budgeted sales revenue, 10,000 units at $10 a unit is 100,000. What about the budgeted costs? And certainly if you look at the last line of the question, it says we're using marginal costing. So if it's marginal costing, we look firstly at the variable costs, which are materials. We've budgeted on 50. Labour, 25. Variable overheads, 12.5. And so the variable costs, the original fixed budget, has a total of something like 87,500, and therefore a budgeted contribution of 12,500. That's the contribution, but of course there are fixed costs. We've budgeted on 10,000. And therefore the budgeted profit 2,500. So there we are. There is our original fixed budget. There's our target for the year. It then says, though, at the end of the year, the following costs have been incurred for the actual production of 12,000 units. So if I look at the actual costs, well, again, I'll look at the revenue first. The actual sales were 12,000 units for a total of 122,000. Our materials, actuals was 60, labour 28.5, variable 15. So the total variable costs 103,500, giving a contribution of 18,500. Have I did it right? 88,9,800. Yes, I have. And of course there were fixed overheads of 11,000. So the profit 7,500. So overall, obviously a lot better than we forecast. However, I said one reason for budget so we could compare, but to compare those two would be silly. You see, look at the materials. We budgeted on spending 50, we actually spent 60. We've overspent by 10,000. Well, I can hardly blame the materials manager. I'm not going to say sack the materials manager. Why have you overspent? Because the reason we have spent more is, have a look, we produced more. My original budget thought we'd only produce 10,000. We've actually produced 12,000. You'd expect to spend more. And it's not the production manager's fault that we've produced more. And so if we're going to use it in this way, to be fair, to make proper use of it, we should compare what we actually spent with what we should have spent for the actual level of sales and production. And so to make it a sensible comparison, what we call flex the budget. And we rewrite the budget for the actual sales and production. Now, the actual sales production were 12,000. And so we use the standard costs that we had originally. But we say if the original budget had been done on 12,000 units, what figures would we have had? Or what about revenue? The budgeted selling price was $10. Given I sold 12,000, 120,000 is the revenue we expect now. What about materials? We budgeted on 50,000 for 10,000 units, if you remember. So we thought it would be $5 a unit. Well, let's redo it. At $5 a unit, for our actual production of 12,000, how much should we have spent? 60,000. Labour. We budgeted 25,000, which on 10,000 units is $2.50 a unit. Look, $2.50 a unit. For the actual production of 12,000 units, what should we have spent? 30,000. Similarly, variable overheads. The original budget was obviously $1.25 a unit. 12,000 units at $1.25. It flexes, it would be 15,000. And so for the actual level of production, the variable costs you would have expected to be 105,000. The contribution, therefore, 15,000. Fixed overheads, of course, by definition, should have remained fixed at 10,000. And so although the original fixed budget was for 2.5, because we sold and produced more units, even if everything else had gone perfectly, I would have expected to make 5,000. So why did we make 7.5? Well, now we can go down and compare, and it's a valid comparison. You see, revenue. We should, for our sales, have got 120. We got 122. We've made a gain. There's a difference of 2,000. And although you should have done variances in paper F2, and although we've chapters on them later, I may as well use this to remind you, that difference we call a variance. And if that difference is going to result in more profit, we say it's favourable, or F for favourable. And here, of course, on its own, more revenue than we expected will end up giving us more profit. What about materials? Well, although at first it looked 60,000, 50,000, he's massively overspent. In fact, he's done a perfect job. Wasn't his decision to produce more, but given we did, he should have spent 60. He did spend 60, no problem. What about labour? Spent more than the original budget, but again, you produced more, we expect to spend more. In fact, he spent less. I'd have thought he'd spend 30, you only spent 20. We've saved 1,500. And of course, if we've saved money, that would give us more profit as well. It's favourable. Variable overheads, well, whoever's in charge of them, things have gone perfectly. Now, finally, what about fixed costs? Well, they should have stayed fixed. And of course, they haven't. We've spent more. We've overspent by 1,000. And surely if you spend more, that on its own means less profit. We use the letter A. A equals adverse. And so we now know who's done well, who's done badly. You know, whoever's in charge of labour, maybe we'll give them a bonus because they've spent less. Whoever's in charge of the fixed costs, well, I want to know why we have spent more, and unless there's a very good reason, you know, maybe I'll replace the person in charge, but it's a way of measuring the performance. And of course it should explain the flex budget we expected to make 5,000, made 2.5, well, 7.5, made 2.5 more. We now know why. The net total of these, save 2 there, save 1.5 there, 3.5 in total. We now know where that extra 2.5 came from. Now I said that's, well, my purpose here was to show what a flex budget was. Variances themselves, that's a very, very baby one. If you've done F2, that should be trivial. But equally, if you know F2, done F2, you'll know full variances gets more complicated, and there's quite a bit extra we need to learn at paper F5. Anyway, there's your flexed budget. It's where we rewrite the budget for the actual level of activity and the reason for doing it, which I hope I've made clear without repeating, is we use it for control purposes. Compare actual with flexed. Okay. Finally, be aware of what a rolling budget is. What this is, it's better making up a tiny example and then I'll explain what the benefits and problems are. Just suppose, I mean, most companies do a budget for the coming year. So maybe in December, we do a budget for January to February. Well, let's put a year to it. Suppose we're in December 2007. You do a budget from January 08 to February 2008. And for most companies, that's then it. They may update it sometime during the year, but otherwise, next December after, they'll do a budget for the following year. What we do with a rolling budget is we do a budget every month. So next month, January 2008, we again budget for the following year. So in January, we'll budget from February 2008 for 12 months to January 2009. And similarly, February 2008, we'll budget for the following 12 months. So March 2008 through to February 2009. And so on. I think you see what I mean. And every month you're doing a budget for the following 12 months. Now that sounds awful, although I do appreciate what you're doing each month. Remember, at the end of December 2007, we'd done January to February. January, we're doing February to the following January. So we've already got February. Oh dear. Sorry, that should have been January to December 08. I do apologise. Oh dear. December 07, we do the following 12 months. January to December 08. January 08, we do February 08 to January 09, and so on. So when I come to do January 08, I want February to January. We've already got February to December. So all we need to do is update those 11 months and add an extra month. So each month, update the existing 11 months. Add an extra month. So it's not quite as bad as it seems. Now, the advantages of a rolling budget, the benefit, there are two to be aware of. The first is a very obvious one. The budget is always more up to date. Every month you're updating 11 months that's already there. The other benefit is less obvious. Companies who just do a budget once a year, I don't know if ever you've been involved or seen other people involved, but you know, the managers all have their ordinary jobs to do. All of a sudden they're told it's budget time. You know, you've got 3 weeks or whatever to do the budget. And so they're under a lot of pressure. They tend to be doing it in overtime. They're perhaps doing it faster than they would like to do. They've forgotten how they did it last year, so it's taking time to sort things out. And as a result, so often they make mistakes. You know, they realise later they could have done something better, but it was just they were under pressure. They're not used to doing it. Well, the benefit of a rolling budget is it becomes part of normal work. You know you're going to have to do it every month. And so you start setting aside time. You know, you become under less pressure. There's less work to do because it's the updating and adding a month. And of course, you don't forget how to do it. You know what you're looking for every month. And because of this, it tends to lead to more accurate budgeting. Accuracy is the wrong word, I beg your pardon. Budgets are never accurate. It tends to lead to better budgets. So although it's not, in fact, terribly common, it does have real benefits. I'm not going to write, obviously it can create more work overall, but once it becomes part of your normal job, then actually, well, I think I've said enough.